So, David, for Halloween, we're going to kind of launch into some of the horror stories that you've seen over the years. I mean, you've been a financial advisor for how many years?
Just over 10, yeah.
And hopefully you've seen more good things than bad. But today we're going to talk about some of the bad things that you've seen, and then we'll go into some of the good things. So start with some of the horror stories that you've seen over the years.
Yeah, clean at this stage, over a decade in financial advice, I've seen too many horror stories and I care to take account of. But yeah, a couple of ones stood out recently. I suppose one that always comes up is, constantly meeting people that have, really, really high savings balances, but then they're just in this habit of continuously taking out debt. And I suppose it's really devastating over time because, on one side, you've all of this savings just sitting there earning 0% interest, and then you're constantly, I suppose, paying interest to a lender of, let's say, kind of 7-8%. So you're losing money on kind of both sides of the house. And obviously the advice there is to just break the cycle, use the savings to kind of finance the next car rather than, continuously going into debt, and get your money working for you rather than just, being in the situation where some of your income and your disposable income is just constantly being eaten up in repayments.
And I think the thing is, if that is over a very long period of time, there can be a lot of money lost, and it can be a horror story for people. Like, why do you think that people leave money sitting in savings and take out debt?
Yeah, it's a strange one. Like, I mean, I suppose like people have this kind of cautious mindset that they like seeing the cash there. And I suppose the argument that people always come back to me with is, oh, if I lost my job, if there was an emergency, I have all of this cash there. But then on the flip side, if there's an emergency or you lost your job, surely it's not in your favor having this financial obligation of 500 per month to some, car refinance company, and it is like, I mean, like if you've client A who, constantly avoids debt, and, he gets his money working for him, so he's never suffering interest to a lender. And then on the flip side, the money that was going to a car repayment might be going into his pension or going to an investment savings plan. And you client B then, who's, I suppose, suffering interest of 7-8%, his other money just sitting there earning 0% because he's been too cautious. And then I suppose he has this perception that he can't afford to make pension contributions, can't afford to invest because his money's been eaten up in debt repayments, or his, a portion of his regular
And
income. It's huge if you extrapolate that out over, 5, 10, 15 years.
when it's
Yeah.
explained to people, is it taken on board? Like, what, are people apathetic to the whole, you know, take your money out of savings, pay off your debt? How do people perceive it?
Yeah, some people do take my advice, I suppose, when you put it that way. Unfortunately, not everyone does. Some people look, they're just, stuck in the mindset, and they just like seeing the savings there, and that's fine. Look, I mean, look, as advisors, we can only try educate people and advise them and hope they take on board what we're telling them. Yeah.
And Nick, for you, what horror stories have you seen over the years? Because there's been many years there where you've met a lot of different clients in lots of different circumstances.
Yeah, and a lot of it, unfortunately, comes back to poor advice that they may have been given, or indeed, unfortunately, for a lot of people who do seek financial advice, it could be from someone who's a tied agent, so it doesn't give them kind of the scope of talking about different types of financial products, for example, from different companies. One of the ones that we tend to focus a lot on is in relation to kind of tax, and we would be sort of more specialist in that area. And unfortunately for me, and I would have had a lot of experience in this I've been a financial advisor for unfortunately a lot longer than David, is that it requires a little bit of planning and certainly time in advance. So for example, I've come across clients recently who bought a property. They were quite wealthy. They had a number of assets where they transferred a property into a child's name. The property was valued at 500,000. The child themselves couldn't really get onto the property ladder for certain reasons. But the fact is that unfortunately it incurred a tax liability to the child. So for example, we have this threshold currently of 400,000 that a parent can give to a child. The property was valued at about 500,000. And they were unfortunately, sadly, kind of disappointed to find out that there was a liability of 33,000 to pay, which they actually paid for the child, which actually ironically incurred a further bill of another 8,000 because
Well, that's a bit of a horror story.
the gift itself. And look, at as much as I admire the fact that the parent wanted to gift the property, it could have been done in a slightly different manner that could have mitigated against that. And I always talk to clients about making sure that they are planning and thinking ahead. So for example, in that instance, if let's say a parent had the ability, and it could be in the form of cash, it could be a property asset, where they weren't specifically going to give that asset to the child. They may be trying to help them out. I talk to a lot of parents who, like myself, I have 4 kids in a blended family with 8 ranges aging from say 20 down to 10. We expect them, we probably have to realize that we have children with different needs, different abilities, different requirements, that it's this kind of not one fits all. And typically when it comes to things like property assets, it can be quite burdensome on parents. I mean, if you think about it, this gift or inheritance tax, if you have one child, 400,000, it means typically that they're going to suffer tax at some point in the future. Most parents who gift, even on inheritance, i.e., when they pass, and I know it's a very morbid topic, but they'll end up leaving a large tax bill behind them. And we say to them, look, you can plan more effectively. You can gift, for example, 6,000 a year as parents to a child. Done over a long period of time is really powerful. And then when they meet people or have grandkids for that person, that money can be spiraled into those individuals as well. So if you think about it, if let's say your son or daughter has a partner and they have 2 children, that's 4 people in the family that potentially that parent or indeed that grandparent, obviously depending on the individual involved, can give 4 times 6,000. That's 24,000 a year over 10 years. It's 240,000. That forms no part of that, those limits. Also, the partner of a son or child can be given 20,000 as a lifetime limit in addition to the 6,000, and the grandkids can be given 40,000. So if I was a parent and if I wanted to try and help my child out, and if I had the financial wherewithal, I wouldn't be giving them over 400,000 in any asset or cash. And I would look to maybe pass monies, if I wanted to give them more than that, through other individuals, such as the partner or indeed the grandkids. So that 500,000 could have been passed, 400,000 to the child, 20,000 to the partner of the child, and 40,000 each to the 2 grandkids, and there will be no tax liability.
So as this is a Halloween episode, is that a trick or a treat? Because there is a trick, isn't there, in that, and this was something that was discussed last week about gifting a site to a child tax-free if you have land.
That's right. So again, there are tricks. I would see that as a treat, by the way. But the trick is that it's really important to understand about, what you can do as a parent. And it was something that only recently came up, and we've been, speaking to the tax nerd who has done podcasts as well on episodes and did a recent webinar with us that reminded us that, a parent can gift under certain conditions a site to a child as long as the site is no more than an acre and has a certain value. And I think it's really important because certainly for me, it was something that I wasn't even aware of, and I pride myself on being quite up to speed. And tax rules change. There are certain things that parents can do. I think it's really important for us to kind of understand and explore without necessarily being experts, to make sure that we are getting that guidance and advice from professionals.
And I don't mean to laugh or whatever, but like we are kind of all zombies, right? We are, until we get to a certain age where you kind of start planning it, because I think a lot of us are just caught up in our own lives of kind of busyness. But you actually have to really do and act on this from an earlier stage where the planning has to be years out, really. And when you're financially maybe independent and can afford to start gifting money to children, it's the right thing to do. It makes sense.
It does, but it can be very difficult. And I saw this in my own situation personally, where, my father had some properties, and it's just a topic that many families struggle with, this kind of, and again, perhaps in more of an Irish context, this sort of talking about money even is still
But even
something.
talking about death and passing, like people really don't want to think about their own demise, and want to think that it's a long, long way off. David, any more from you that you can kind of divulge?
Yeah, just to kind of add to Nick's, there are a lot of kind of tax exemptions out there in Ireland to mitigate against tax, whether that's kind of farm relief or business relief or dwelling house relief. But unfortunately, they involve meeting certain requirements or ticking certain boxes well in advance of actually gifting the money or availing of that relief. So it is important to plan early on and get advice early on. And I suppose just kind of related to that as well. I met a client recently who I suppose was paying for an income protection policy. The premium was over €200 per month. He's been paying it for about 10 years. But he's
So what
also
does that
working
work out
for,
as if I'm trying to kind of do my maths? It's like over 2,000 a year for that's nearly
yeah,
over 20,000.
exactly. So he was paying for this policy for over 10 years, but he was also working for a multinational company who had income protection for all
Whoa.
staff. Okay. Now, for people that don't know, with income protection, you can insure up to 75% of your salary, inclusive of what the state provides if you're out of work, which is state illness benefit of about €12,000 per year. And you can't get more than that. Okay. So with this particular individual, he was paying for a policy for over 10 years for something that he couldn't even claim.
Oh
So over
God.
€20,000 down the drain, basically, for being overinsured or double covered. And it's really, I suppose, a case of saying, if you do reach out to a financial advisor early on and try to identify, these, I suppose,
What you
unnecessary
need.
leakage areas, or as I call them, and just try to get your house in order, it can save you a lot of money and avoid a lot of kind of horror and unnecessary
Absolutely. And like
expense.
the
Yeah.
thing is, when you think about it, if that 20,000 had been put into a savings plan with maybe kind of 5 to 6% growth, you'd nearly have, okay, a deposit for a house.
Yeah,
Maybe not
yeah,
quite,
exactly.
but close. So I suppose on the flip side of the horrors, let's try and bring a little bit of positivity into it. From some of your wealthiest clients, what money lessons have you learned?
First, I think it's important to kind of consider, what is wealth, because I think people have a perception that, being wealthy is related to the income that you earn or the salary. So, we have an idea that somebody's in a high paying job or they have a successful business, that they're wealthy. And it's not really, it's more about, how much of that income you can hold on to and get working from you, get working for you, and try to, accumulate assets and accumulate wealth over time. Because if you're somebody who is in a high paying position or has a successful company, and you're able to maintain a salary of 100, 150, 200 grand a year, but you've created a scenario where a lot of that is just kind of wasted through constant debt and loan repayments, or, luxury items that you don't need, and you're not actually saving or maintaining a lot of that money, you might find yourself in a position where maybe somebody on half the salary that you're on is actually much wealthier than you. So it's really kind of the decisions, Cliona, that you make in terms of kind of how what you do with your money and how you allocate it results in us being
Yeah,
kind of
because I
wealthy.
suppose some people are maybe more spendthrift than others, and some people then are probably better savers, are actually just saving into the right vehicles, whether that's a pension or whatever that may be. Nick, what are the tips that you've learned from, or not even tips, but I suppose lessons that you've learned from some of your wealthier clients and things that they consistently do right?
Well, I mean, in many cases, we actually educate them to do the right things. But just following on from what David said, interestingly, one of the things that we do in Alpha Wealth as part of our financial reviews is that we do these kind of financial projections for people, showing them over the short, medium, and long term. And we have this notion of what we call financial independence. It's kind of reaching this point in time where it could be at 55, it could be at 60. Notionally, what allows somebody to not have to work. It's not saying that they will retire, but it allows them the ability to say, well, maybe they will start to change career, go back, go down to 3 day a week or whatever it might be. And this whole notion of kind of phased retirement, allowing you the ability to kind of start to ease off the throttle, if you like. And by doing just simple things, and it's really powerful to show them, visibly, like what that looks like, and yes, okay, there are different types of things that they can do in terms of savings for the long term, traditionally pensions, but not always. And making sure that they have those things ticked off. The concept of financial independence sounds a little bit holistic. It's very simple, no debt, having all debt cleared, which is why we find it's a really big aspect of helping people with their financial goals, not taking out unnecessary loans. The second thing is obviously covering future expenses, seeing their cash flow forecast, which is quite powerful, and being able to sort of visualize how they can fund like children through third level education and beyond, and meeting future payments that they may have. And then finally, this income stream that is a passive form of income. It could be through rental property, it could be through pension provision, and allows them to understand about notionally what that age is. And I always say to people, like, let us help you get to your number, whether that's 55, 60, 65. And it's really about finding the straightest road, not taking the windy road. because a lot of us probably understand the things that we probably should do. And it's like everything else. It's like going to the gym. If you want to get fit, you've got to keep at it. It's short things continuously and understand about where you're trying to aim for.
So, David, if I'm going bobbing for apples, right, on Halloween night and I want to get that apple with the most kind of coins in it, what's the big tip that you would kind of give to anyone looking to be more successful with their money?
Yeah, so like Nick was saying, I think it is very much about, you know, adopting a new mindset or getting into good habits. Like if I look at some of my clients that are, you know, most financially successful, as I said earlier, it's not always the people that are earning, you know, the highest salaries. You know, naturally they live within their means and they try to avoid debt. They're constantly looking for opportunities to get their money working for them. So, you know, I have a particular client, when he identifies that he's spending less than he's earning and he's more disposable income, he's constantly on looking to up his savings contributions, up his pension contributions. If he has excess money sitting in his personal account, he's constantly on looking to invest that. If he has excess money in his business account, he's constantly on looking to invest that. And it's just being proactive, I suppose, and reaching out and getting the advice. And I suppose it's about, you know, always looking for clarity as well on the actions that you're doing and where they are leading for you. As Nick said, these kind of future projections are really important in kind of making these calculated decisions rather than just doing things willy-nilly.
Okay, and if I'm going to be the Wicked Witch, what's the one spell that you might kind of say, okay, if you're to give anybody like one parting bit of advice, start with this?
For me, I think we leave too much money behind us in terms of like what we should claim for. And revenue have made this kind of much easier. I keep saying to every individual, there is undoubtedly money that you're owed by the tax man. And it's so simple to get access to it. You know, using ross.ie, claiming over the last 4 years for things that we should have done, even post-COVID, those people who are still working from home can claim, you know, up to 30% of certain expenses like heating, phone bills, utilities, and yet we don't do that. I mentioned...
I'm going to make sure you do it. I'm going to be the ghost that's going to come back and haunt you.
Absolutely. We mentioned there that, you know, we did a recent tax webinar with the tax nerd, and I paid like over 4,000 euros for braces last year, and I haven't claimed the 20% that I'm eligible to claim for. And I'm a financial planner, so, you know, we all do it.
Well, you're leaving money in that pot. You
Absolutely.
need to.
So for me, they're simple things, and it's a real simple tool to use, and still over 50% of people don't use Ross.
But I think it just goes to show that we are all human and we do leave money on the table. And I think it was actually Murray the tax nerd who said it. Like, I mean, if somebody was to put, you know, an envelope of whether it's a couple of hundred or close to 1,000 on the table, would you leave it there and not open it? I mean, the answer for all of us is absolutely not.
Absolutely.
Yeah, I had this conversation with a client the other day who could have claimed back all of these tax reliefs over many years, and they didn't. And the good thing is that you can actually go back 4 years. And they were kind of saying, "Oh, look, I just don't have the time." And I said, "Look, you're literally looking at like well over €1,000 here on unclaimed credits. So you sit down Saturday morning, spend an hour." It's like working for €1,000 an hour, you know,
Yeah,
your job's
well,
not paying you that.
The thing is, would you go out trick-or-treating if you knew that everyone was going to throw a tenner into your bag at every door? Yeah, I would.
Exactly.
Anyway, thanks, guys. I think, look, there's a few little nuggets in there, and it was a bit of a fun episode for
Very
Halloween.
good. Yeah,
Definitely.
absolutely. Thanks.